The following is a pre-recorded show. Welcome to Winning in Retirement with your host, Brian Akers, certified financial planner professional and founder of Akers Financial Group. Now, helping you win in your retirement, here's Brian Akers.
Welcome to Akers Financial Group's Winning in Retirement. I'm Brian Akers, president and founder of Akers Financial Group, and we welcome you to our show, Winning in Retirement. We want you to win during your retirement years. So no matter what age you are, we all want to win when we retire, right? I think so. That's why we bring in our specialist, our certified financial planner practitioner, Alex Monk from Akers Financial Group. Good morning, Alex.
Brian, great to be here.
It's glad to have you. We got a lot to talk about, but this might be a very taxing show for some people. And I had to start corny because I know you're going to bring up more corny than I can to hammer it.
My dad jokes are just off the charts these days.
Right. So that is one of the first things we're going to cover when it comes to tax time tips. Alex and I have been staying up late, waking up early, thinking about tax time tips because it's filing season for your taxes. That means your income taxes are coming due April 15th-ish.
I think it's 17.
It's going to be actually on regular time this year for the first time in like 3 years that we know of.
Allegedly.
All right, so what we're going to do is this. We want to give you tax time tips to help you keep more of your money. So when you're doing your tax returns or having somebody else do your tax returns or working with an accountant, CPA, tax preparer, when you're working with them, you know how to bring it, what you need to do, how to prepare, and make sure you maximize what you deserve back.
And really with taxes, so, we're talking about tax time because it's that time of year, right? But it's a long-term game that we're playing here with taxes.
Absolutely.
We're up against them every single year forever. So
correct. You don't run away from taxes unless you don't make any money at all.
Right.
Or if you had all your money tax-free, which that's hard, almost near impossible to do.
It's tough to do. Yeah. I've seen it done a few times, but it's hard to do. So you're sitting there looking at your taxes like, am I doing everything right?
Yep.
Because if you're plugging it in on a computer, that's a little, it's a little scary because I've seen clients like they've been on a Zoom or whatever, and they're like, can you look at this TurboTax thing? And I'm like, I have no clue where these questions are coming from.
Well, but Alex, you're an accounting major.
And then I want to see the forms, man.
And then Akers Financial Group, and we own a tax preparing company called Daniel Allen Tax. Daniel DANAIEL, Allen ALAN Tax TAX.com. If you go to that website, you'll see Daniel Allen Tax, basically our private tax preparing company, which prepares for many of our clients and other people out there. We do that out of our main office in Forest Hill, but we do service clients all around the country when it comes to tax returns. So when we're talking about taxes today, what we're going to talk about is how to prepare, how to basically think about things, and then understand maybe a difference between doing it yourself, having somebody do it. There's lots of choices out there. And then as you hit different levels of complexity, there are CPAs and other advisors you bring in when it comes to your taxes, and you got to know what's going on because we want you to keep more of your money. That's a bottom line main goal in our tax time tips for today. So first of all, let's just talk about the basics, the mail. Things are coming in the mail. What should people be doing?
They should look at everything that comes in, first off, right?
Okay.
You get a lot of stuff at the end of the year. You get year-end statements, and sometimes those year-end statements may have tax information on it.
Absolutely.
So if you're, wondering, where's all my money at, or where is everything, this is a good time of year because you're getting information on everything you have.
Now, the envelope sometimes will say important tax information enclosed on the outside. That's always a good hint that you should save it and save everything inside of there for the tax preparer. Because you might be in a fund, and that mutual fund might own something Maryland tax-free, and you might get a little bit of a credit on tax-free interest.
But it might be on the back of page 3.
Oh, yes, or in very small writing. All right, so we have a couple of premises I want to cover. One is this, is that your tax information is your tax information. So you got to gather it and put it together, and then you officially sign your own return. But what happens is if you prepare it yourself or if you have somebody else prepare it, you go to them with that information, and then that tax preparer is going to do a couple of different things. Sometimes they're just going to keep score and write all the numbers you give them down and say, boom, here it is, do it as fast as they can. They hand it right back to you. You owe this much money, and you're on your merry way.
It reminds me of like the guy with the visor and the cigarette and the little the type machine.
Sure.
Old school. Just tell me what you got.
Right. Tell me what you got. Now, the problem is we don't know what to tell them in a normal situation. We just, oh, this is what came in. This looks like last year. Is it really like last year? Is something changed? Like in the Monk family, there's baby Monk that arrived.
Yes.
So now you get a new tax deduction.
Hallelujah.
It's a wonderful thing. That tax deduction needs to have a name and a social security number to take the tax deduction.
Yep. I got that.
You got that, so you're ready. You're ready. So that's just a simple little change. You could have had another change where you got married this year. If you got married before midnight on 12/31, you can be married filing jointly for the whole year.
But so wait a sec. So you're saying that more than just the numbers matter.
Sorry. I thought you were getting real serious there. Yes, more than the numbers matter. It's the story. The accountant or whoever's doing the tax might not want to hear the whole story. They might say, give me your folder, and they go rush to their cave to do it. I had one client had a guy pull up in his car. They come out, put it in the window. The guy does it by hand in the car.
DoorDash?
Basically a DoorDash tax return. But then I review the return and go, where did these numbers come from? They weren't right. Now, some things that we do as financial planners, you bring in to us as a planner, as an advisor, the last 3 tax returns, because before you file your 2022, you can go backwards and fix the last 3 returns. But as soon as we file 2022, we cannot go back 3 years. We can only go back 2 years.
And that could be a big deal. Like you can save a lot of money by doing your taxes the right way.
Lots of money where you can actually save advisors' fees and save other things by having people help you. You'll be amazed that if you try to go through a return that's not just a free basic return through the websites, but if you have it where you basically don't qualify for free, you're in the paying in the 100, 150 range just for the software for you to do it yourself.
At least. And then you have filing fees and stuff like that. So, I mean, you're looking at like $2.25, $2.50 typically.
Yeah, just a direct.
Yeah.
And then it's really not that much more to have a tax preparer do that. And then if you add a CPA, they'll charge more because of their qualifications and their abilities. And so they charge more than that. So knowing what you're paying and what you're getting is very important. During tough times, changing times in life, a tax accountant can actually really benefit you. And that's why we want you to understand reviewing your tax information and gathering it all is very important. What are some things that people typically forget, Alex?
They forget their miles for medical.
Miles for medical. So in 2022, you can take 22 cents a mile off your Schedule A, your itemized deductions. So itemized deductions, 97% of Americans will not use itemized deductions. But if you had a big year in medical and charity and $10,000 in state and real estate taxes, you might hit that limit and it might qualify you to do itemized deductions.
Right. And even if it's close, it could help you more on your state return because of the mechanics. So,
Explain that one a little bit more.
Okay. So, like, let's say you qualify for the standard deduction because you don't have enough itemized.
Sure.
So that means on your state return, you're automatically standard.
Yep.
But there's a huge difference in standard deduction amounts when it comes to the state side because it's like $2,000-$3,000, something like that, $4,000.
It's very low.
It's very low. So if you have itemized, you're automatically going to be at least $14,000 if you're married. Because you back out state taxes at $10,000, so you're already $10,000 ahead of the game.
Sure.
So that little bit of difference saves you 7-8% in tax. That could be an $800 swing.
Right. So the idea is you can optimize your overall taxes between Maryland and federal, and by understanding can you itemize or not. So some people don't give their itemized information to their accountant because they think, oh, I didn't itemize last year, I'm not going to hit it this year. You never know. What we recommend is this. The key to this first thing at tax time, if you want to keep more of your money, give more information.
Oh, yeah.
Provide more information. Let the accountant, the preparer, the professional decide is that deductible or not. If you're in business, absolutely have lots of receipts, a lot of information. If you have your own home, if you have things that are tied to charity, you can have charitable miles. When you go to do charitable work, you can deduct flights, like airplane flights. You can deduct the mileage, 14 cents a mile. This all piles up as deductions to your bottom line, giving you more money. But you need to provide the information to the accountant because the accountant does not know what you did. They know what you did last year, and you could say something like, oh, just the same as last year. Is it really?
It's never the same, though. Never.
I don't think it's ever the same. Life changes, things change, and you don't know how great it could affect your taxes. And that's what makes it fun for as advisors, CFP, certified financial planners. What we end up doing is we get copies of every tax return. We hear your whole story and we go, oh, well, in 2020, you could have done this. And we go back and redo the returns. Well, ones that we've redone recently are the fact that, you donate to your Maryland 529 plan for your child. You can take a tax deduction off your Maryland. The weirdest thing is I had a client, aunt is a CPA. He never told his aunt that he had a Maryland 529 plan. So they had to the aunt redid the tax returns, and he got a few $100 back, like $400 back.
Good thing he's doing the returns, right?
Yeah, it's just a simple little thing, but that was just one simple way of taking information in financial planning, applying it to the tax code, and getting the client more money because there's more information than we understand.
Right, and if it's $300, that pays your fee.
Absolutely.
So it's there's value that's added, and you don't want to pay. At least I don't want to pay more taxes ever.
So most tax companies that are preparing for you provide like a little letter summarizing last year. Understand that doesn't mean they know everything that's going on in your life. You write everything down, right? Oh, I gave clothes. I gave a car. Oh, I had extra computers. I gave those away. I have a collection of things I gave away. Whatever you do, make sure you write it down. Get receipts. It's all very, very important. Right. So this first quarter of the show, we're trying to hit it hard when it comes to tax time tips to help you keep more of your money. We want to pay our taxes the proper amount, but we don't want to pay more than that, do we?
I sure don't. No.
You don't?
No, I will not be signing up for that.
All right. So you're not going to just check the box to add extra donations to the coffers.
Oh, no. If they want some more, they can knock on the front door.
And they will. They're bringing up 80 thousand more coming. The idea is when you do taxes, have information, have the documentation, and it's good to take those deductions when you have the supporting documents.
And just keep a record of it.
Absolutely. And keep it for at least 7 years. Of course, taxes, I keep it a lot longer. All right, Acres Financial Group. We're local. We're independent. We don't report to a big company on Wall Street. We report to you. We do have offices in Forest Hill and Lutherville and clients all around the country and even some around the world. It's so easy to begin winning in retirement. You can call us for a free consultation with one of our team of advisors by calling 833-WIN-RETIRE. That's 833-WIN-RETIRE. We'll call you on Monday to schedule your free in-person or Zoom meeting. Go to acresfinancialgroup.com or give us a call at 833-946-7384 to start planning for your retirement now. The more time you spend doing this, the greater your possible refund. We'll explain in 2 minutes.
You're listening to a pre-recorded show. Welcome back to Winning in Retirement. Call 833-WIN-RETIRE now to schedule a visit with Brian and his team and begin winning in retirement. Once again, here's Brian Akers.
Yes, welcome back to Winning in Retirement. I'm Brian Akers from Akers Financial Group, and here with me today from Akers Financial Group is Alex Monk, certified financial planner practitioner, has an accounting degree.
Yep.
Investment advisor representative, stockbroker, insurance agent, and father of one son.
Correct.
All right, that's some basic bio. The rest of it you can find out on acresfinancialgroup.com. You can find about any of us, of the team of advisors, through our website. Take a look at our website, check us out. What you understand is that we have one goal in mind, and that's one client at a time to do financial advice, where we sit down, talk about, and listen to your situation. That always leads us to taxes. And that leads us to the show today because it's tax time. And it's also tax time tips time.
It's time for that tax time talk.
It's terrific tax time tips. Come on.
Yeah, that's tough.
Come on, keep going with the teas.
Can't do it.
No, it's fun, though. But imagine that doing your tax return. Some people are excited because they know they're owed a refund. Some people don't like the fact they might owe. Some people know they're not going to do it to the last day because they think they owe. What we recommend is that you get all your information together and you invest some time into this to make sure you gather all the information you need to do your taxes. Because we want this. We want you to keep more of your money when you're filing your taxes for 2022.
I mean, the easiest way to win in retirement, in my perspective, is learn all the rules, taxes being one of the rules, and get good at the game.
All right, so the tease was to spend more time doing this, the greater your possible refund. And it's just a total blank. I didn't give you the answer for this one. I want to mess with you this morning. So imagine the question is, the more time doing this, the greater possible refund. right.
Your hand signals are terrible.
I skunked the monk. That's not skunked the monk. That's pretty bad. All right. What happened is this, is that when I was teasing Alex Monk about the idea of how to have a greater possible refund and what more of this, and the answer is simple. It's time. Spend more time doing it. Open up all the envelopes, see what's in there, see what's not in there. One of the biggest things you can do is talk to the accountant, give them the information, and then give them and talk to them about what's going on. When they call, if you hand them an envelope and they call you back with it being done,
that's a red flag.
I would say, well, can we talk about what other options I could do? Do you see anything else I'm missing? Now, in 2022, there's some things taken away. One of them is the above the line charitable deduction, like that $300 or $600
little kicker on the front line.
Yeah, that's gone there. But you still should give all your charitable information to the accountant. You never know how that's going to help you.
Well, and it also tracks. Like if they put it in their system, it'll track the differences year over year, so that if you ever do have a big year, you have proof that, hey, I've been giving to charity for years. This is not an abnormal thing.
Absolutely. Now, energy credits and anything tied like that, you might get a deduction for things that you bought during the year or in the past, depending on if you have an electric vehicle, depending if you had some type of energy efficient appliances, the windows, things like that.
Doors, yeah. I mean, even if you do like geothermal, I think there's still one for that.
Well, yeah, there are a bunch of different credits. The thing is get all the receipts on things you've spent money on. Anything that says energy efficient or energy credit, bring that to your accountant so they can take it off your taxes. There are limits. There's not as many credits as before, but there are more after the tax law last year than you might know.
Right, and these are like incentives for buying something that may cost a little bit more because it's environmentally friendly, something like that. If you replace your roof, you don't get to write it off. I mean, a lot of people are like, hey, I got a new deck this year. Can I write that off? I'm like, what?
No, it goes to cost basis so that whenever you sell, but the idea of capital gains on a home is hard to have above $250,000 or $500,000 gain.
Yeah, I mean, you have to be there for a while. We have seen it. It's,
Absolutely happens. There is some people don't understand the new rule. The new rule is that if you own your property that you live in, your residence, and you live there 2 of the last 5 years, you can exclude a gain as a single person up to $250,000, gain as a jointly filed tax filer, and up to $500,000 of the gain on the property. You can do it pretty much every 2 years if you have real estate that you live in as your residence.
Right. And people are always like, what? There's no tax on this? No, there's not. Because you live there. It's your primary residence, but you have to have done that.
Right. Now, that only applies to your residence. If you have rental properties, it's a different story. If you have a second home, it's a different story. Can you explain the tax code 1031 in great detail? Actually, don't do it in great detail. Explain just a basic topic for anybody that might be listening.
So a 1031 it's a type of exchange with real estate for something that's not your primary residence.
Okay.
So, real estate used for a purpose like income or, rental, whatever it may be.
Sure.
But it's typically used as a business purpose or investment purpose. Mm-hmm. And when you go to sell one, if it's highly appreciated, meaning you deducted the value of that asset, the cost basis along the way. That's the beauty of real estate. You get to defer income currently,
Yes,
and then depreciate your asset. Well, you can exchange that into a new piece of real estate, tax-free, and defer the gains even further as long as you meet certain criteria. So, there's...
It's a like kind exchange.
Correct.
Yeah.
Like to like, it has to be of greater value. So there's some rules there.
Absolutely. So the reason we bring that up is if you own real estate, which we've found successful people that are building their net worth typically own real estate beyond their house. That's all part of building wealth is owning real estate at certain times. Now, markets might be high, might not be perfect time because interest rates are rising and all that, but there are tax deductions for this. And under the current tax law that runs all the way to the end of 2025, there's even extra deductions for real estate profit.
Yeah.
Which you really got to make sure you give that information to your accountant.
That's that section 199A.
Oh, really?
I believe so.
Once they switched from schedules to Schedule 1, 2, and 3, it really threw me off.
Yeah.
I went to college in the late 80s at Virginia Tech, and we're learning the brand new tax law of 86, 87. It was great when I started my career because I knew the new tax law and all the changes, and I could explain why they couldn't do investments of the 80s had to change because of tax law changes. Now, that law has changed a lot back in 2017 and 18 with the Tax Cut and Jobs Act, but it gave us a window of time with low brackets right now. So you'll find in most of our shows on Winning in Retirement, we believe that tax brackets right now are the lowest we're going to see over the next many years, maybe our lifetime.
I think forever, personally.
Right. So these taxes might be upsetting to take, but you might want to watch out for certain mistakes. One mistake might be accountants call and says, "Oh, you owe $500, but if you put this much money into your IRA, you can actually get more off your taxes." Or if you shift money from your Roth to an IRA, you can get money back on your taxes. And my advice to you is do the Roth instead. Pay the tax unless you're at some high bracket. My opinion, a high bracket would be 32 or higher. Or if you spend your life at a 15% bracket and right now you're at 22, 24, you might not want to pay tax in 1 year at that level. You might want to take a deduction. Depends on your situation. And that's why advice matters when it comes to taxes. But understanding what to do is very important.
Right. And there's other things that we take into account when we do these Roth conversions, stuff like that. And we want to fill up income buckets, but we also watch other limits for clients.
Yeah.
Because you get those little nasty grams from Medicare if you jump some of these levels. And guess what? It doesn't match any tax brackets. Thank you, IRS.
Yeah,
so it's like different levels.
Right, we're going to have a whole radio show on IRMAA and the Medicare premium and what people have as a surprise after they have a big final year of their work history, then how the IRMAA kicks in, and then there's ways to fight the IRMAA premium escalation, especially if you have an income that gets too high for 1 year and you can sort of prove it with the math.
And it's worth it. I mean,
it's worth doing the forms.
A couple $100 a month is a big deal.
All right. So this segment was about more time you spend doing this. And that's about preparing, getting information, giving information to the accountant, talking to the accountant about what's going on in your life, writing it out so they know what's going on. The other thing is this, tax time tips to help you keep more of your money. So if you're a business owner, there's a lot of things you got to keep track of. We'll cover that later in the show. But one of the things that's negative this year is they're lowering the child tax credits are going down. The amount of money, instead of $3,600, I think it's $2,000. Then there's some other credits that are being reduced in the 2022 time period of credit. The other weird thing is that I thought was funny for businesses is that in the one of the laws they passed last year, for the year 2022 only, business meals are 100% deductible. So,
was that like an incentive to go to
back
restaurants?
To go back to work, to get you out there doing business in person. They threw in 100% deductibility of business meals instead of 50% for that 1 year. It's interesting. So if you're doing your taxes, don't automatically count 50% like most software says.
That's nice.
That's just a little thing. So imagine that we love dividends and capital gains. For what reason, Alex?
They are taxed differently, so they're taxed at a special rate. 0, 15, or 20.
And that tax bracket is federal, and that's a really good thing. And so giving the information about your gains and losses on your stocks are very important. Whenever you buy stocks or have an account that's a taxable account, might be in your name or joint or even a trust account, you need to track and keep that history of the stocks and investments you have, so that you have proof later of your cost basis, so you only pay gain on what you earned.
Right. You don't want to tax yourself doubly. And, this year is going to be interesting for people because they now have interest income, which is taxed as ordinary income.
Right.
But the banks were paying, right? So people were getting some money, in interest. So that stuff's taxed, if you're in the 22 bracket, 7% higher than your dividends will be if they're qualified.
Absolutely. And so the idea here is all about information, getting that to the accountants, make sure you know how you're investing. We enjoy investing in stocks that pay dividends on a personal level because of the tax. It's actually cheaper tax than interest.
Right. So if you can save 7% tax just by where you structure your different types of investment, that sounds like something you want to do.
Any little way to save some tax money is a very good thing. Keeping the information is very, very important. All right, so I'm going to try this little story. I want you, Alex, to see how this story goes.
Take me.
So imagine this. You meet a friend for lunch, and you get there first, and you sit at a table. Now, it might not happen for all of us getting there first, but it's a good to imagine. And you see them walk in. They look like they've seen a ghost. You ask, well, what happened? And they said, did you see what happened to the stock market this morning? I lost a lot of money. And then you said, I saw what happened. What do you want for lunch? Like you're being all cool and chill, right, Alex?
Oh, I definitely.
That's normal. And then the person says, lunch? How can you be thinking about that? And then you let them know that you have a retirement plan that isn't just dependent on what happens on Wall Street and that you're going to be fine. It's all noise. When they ask you who helps you with your retirement plan, you can tell them about us, Acres Financial Group, how we helped you create a retirement plan that can withstand fluctuations in the market or increasing interest rates or inflation or all three. We've seen all this happen before, and we know it will happen again. So we can guide you to create a plan that can help you thrive no matter what financial storms come ashore. Give us a call at 833-WIN-RETIRE and schedule a free in-person or Zoom meeting. That's 833-WIN-RETIRE, 833-946-7384, or visit our website at acresfinancialgroup.com. Scroll down to the bottom of your homepage and schedule a meeting there. Call 833-WIN-RETIRE or go to acresfinancialgroup.com. You don't want to miss this deadline. We'll tell you what it is in just 2 minutes.
You're listening to a pre-recorded show. Welcome back to Winning in Retirement. Call 833-WIN-RETIRE now to schedule a visit with Brian and his team and begin winning in retirement. Once again, here's Brian Akers.
Welcome back to the second half of Winning in Retirement. I'm Brian Akers. Here with me today is Alex Monk. We are both certified financial planner practitioners from Acres Financial Group. What that means is that we're financial advisors here to advise you on your retirement. The show is general in nature, of course, and we talk about topics and advice and how we apply it to clients. What you need to do is sit down with us one-on-one to be able to find out what kind of advice would apply exactly to you. So make sure you seek out a certified financial planner practitioner to help you do that, right? All right, so Alex, welcome to the second half. I know you're excited about the news the last couple of weeks.
I am.
They actually had one headline said a new monk in Baltimore, and I'm thinking, I thought you were the monk in Baltimore.
Well, so it's interesting play on words there, right? Monk in, like he's in Baltimore, but it's like it's so close in name. I like hearing it, but ugh.
All right, so who is this guy?
He's the new OC for the Ravens.
And what's his name?
Todd Monken.
Todd Monken. All right.
So
You're okay with that, right?
we'll see. No comment. I don't. You know what I mean? I don't want people to not like me. I don't know.
No, we'll see what happens when it comes to football. All we know is finance. Let's get back to the taxes. So Tax Time Tips is the name of our show. And yes, Alex Monk is here from Acres Financial Group with Brian Akers. And we're talking about tax time tips. And the reason we're talking about it is because we want to help you keep more of your money when it comes to taxes. Some of the basic things is how we gather our information, how we talk to the accountant, how we organize, how we know what to keep track of. What we want you to understand is know your situation and keep track of everything so you can turn it in. And that's extremely important. So in this segment here, we're talking about this crazy question. Let me see if I can ask it properly. You don't want to miss this deadline. What deadline are we talking about for this third quarter here, Alex?
This is hold on. Oh, no, we know this one. So this is the Roth and IRA contribution deadline.
Absolutely.
It's the same day you have to file your taxes, typically.
Yeah, that's exactly right.
So it's an important day.
All right. So what that means is that for 2022, if you want to do an IRA, which could be deductible or non-deductible, or to fund your Roth IRA, you have all the way until you file your taxes. And we believe April 17th this year.
Yeah, it's like a Monday or something like that. 17th, 18th.
You're making me look at the calendar.
Yeah, it's something like that. It's in April, near the middle. But I think they give you an extra couple of days.
Yeah, 17th is a Monday. The funny thing is that the April 15th is the day, and it hasn't been typical for 3 years. It's been in like June, July. It's been all over the place.
And I think the last year it was on the 18th because of a holiday or something.
Yeah, there's an extra holiday thrown in there. And then there's some people in California due to storms, got an extension already into May. So unusual tax time.
I mean, we have so many clients that just extend to October. That's their new norm now. That's what they just do.
Yeah, and sometimes you do that. We just don't want to deal with it right away. The IRA deductions, things like that, is still April the 17th. The business retirement contributions can be extended. It's the way I understand the minuteness.
Yes. They figure you have more complexity going on if you have a fiscal year with the calendar year.
Right. So let's talk just simple about Roth IRA. Roth IRA, someone under 50 for 2022 can put in $6,000?
$6,000.
And someone that's over 50 years old could put in 6,500 or 7,000.
7.
It was 7 for 2020.
It was 7 last year, yeah.
Right, and then that gets indexed into 2023. Not going to throw that number out right now, just to mess with everybody. But the main idea, it is higher because it indexed with inflation, which helps tax brackets and a lot of things. And it actually helps the fact you can make more money in a lower bracket generally, which is nice. These tax deadlines mean you can put some money in. You don't have to fully fund a Roth. You can put some in. You don't have to put it all in.
Well, and so there's a lot of people out there that are retired. They have a little part-time gig, and they rush in here every year at their W-2. Alex, $4,217.18. That's what we're putting in the Roth this year. And it's the best type of money to pass on. So, let's get excited about being able to save it still.
Even if that's a shift from your investment account into your Roth IRA, we can create the investment tax-free to the future. I think it's a why not?
Yeah.
Now, if someone makes $10,300, how do you fund the Roth IRA?
Are they married?
Yes.
I would do 7 and the difference to the other one based on who worked.
Right. So
Or
if one person insists on working in retirement and they make $10,350 or whatever I said, that money is money that the family made, and all of that can go to a Roth, the same gross amount, but you divide between the earner and the spouse.
It's really nice. So like all the lazy husbands out there can still get credit for their Roth. No offense, but
Well, I'm glad you said it in that direction, which is good. All right. So the next thing we're talking about is businesses. You have a business, and so the 2022 year's over. Is there something you can still do?
Yeah, I mean, that's a little bit of something you can do. It's not a hard deadline, which a lot of stuff, like if you want to sell something at a loss, it's the end of the year.
Correct.
No ifs, ands, or buts. So that you have a little bit of wiggle room.
All right, so give me an example of, for business retirement plans, what can people do?
Oh, so the business has all the way up until October 15th when the final extensions due.
Right.
And a lot of times that's because they have to calculate the business income for the year, because a lot of times that has some type of play on the allowable contribution, depending on what type of plan they have set up.
Right. So if you have a company, just you, there's some wonderful plans out there that you can put a lot of money away if it is all you. Now, you might have a lot of 1099 people that do other work for you. You farm it out, and you are sort of the person who's maybe the consultant, the contractor, or whatever that's bringing in that cash. Now, such things as basically a SEP IRA, where you can take your net profit, 25% of that, and you can put into a retirement plan.
Yep.
So what happens is you meet with the accountant, they run your numbers, and you say, well, how much could I put in the SEP this year? And then they tell you a number, and then you call the investment advisor, and then we tell you, yeah, let's go ahead and do that.
And a lot of times we're waiting for that number.
Right. And so it's sort of like we don't just file a return blindly. We think about some planning things we can do.
Yeah, and there's so many cool plans out there for business owners. The Solo K that they opened is really neat.
Yep.
Very cheap to, you don't have these huge plan documents and third-party administrators involved. It's just clean, and it allows business owners to really sock away a lot of money.
If you have a 401k and you're a medium-sized business, there's ways of actually having a discretionary match, or you can add some extra money to the plan to get spread around everybody. Some companies do that, and you can do that to the full extension. There's just a lot to do when you have your own business accounts and your business, you're running your business and you're making profit. There's a lot to do. The businesses also have some also special tax advantages for this current tax law that lasts until the end of 2025.
Yeah.
And so that's if you have a business profit and you make under certain limits in the $300,000 range, you can actually have a deduction off the profit that you're showing on the return.
And then you still get to free front load assets that you buy and things like that. So you can really play around. If you have a huge tax year and you bought some stuff that's usually spread out over a 7-year period, 10-year period, it can really help offset it if you do it all up front.
Absolutely. The other thing about business taxes, if you have business miles, last year the tax mileage rate for business was one rate until July 1st, and it changed to 62.5. And then January 1st, 23, it jumped up again to 65.5 cents a mile that you can take off your taxes from business miles.
Inflation
and oil prices, right?
Yeah. I mean, at least so that kind of a change in the middle of the year, that matters. Like, you need to write down when you went places.
Well, it's like I had this one company where they're getting a car allowance, and then I said, well, why don't you do it another way? Just do the business miles. And that ended up being a lot better for them because the business model gave them a lot bigger deduction because they drove a lot.
Yeah.
So there's many, many things to do when it comes to your taxes. Our show today is tax time tips that'll help you keep more of your money, help you have a bigger refund. So if you get to know your tax return, you have your basic income that you fill out on the front page, and you'll see some sections that might not make sense. You might see something that says interest and then tax-exempt interest. What is the difference there?
So that's just based on how that interest would be earned.
All right, so an example of tax-exempt interest?
Would be like a government.
Okay, like a federal or
like
Maryland? Okay.
Like a state or a federal issued.
Right, so a state bond would not be taxable federal. A federal bond is not taxable in the state. So let's say you bought a treasury bill. When you do your Maryland tax, make sure they catch the fact that you don't pay Maryland tax on that interest.
Right, and a lot of people in Maryland, they might own that T-Row Muni Fund, Maryland Muni Fund. I see that all over the place.
Yeah.
And it breaks it out. But it's on like the third page. You got to make sure you look for it.
But you have to enter it in the return.
Yep.
Very, very important. Now, there's lots of things to say about investing and taxation. We're just trying to cover some simple ideas on ways to get you more refund. Any general thoughts on getting more refund for people?
Well, I look at it as paying taxes on our terms is my goal for people.
Sure.
I'd rather not be surprised. I never want a big surprise. Like, that's always the worst. Because if you get a big surprise and it's like, oh, I get a huge refund, it's like, well, what was I doing? What did I miss?
Correct.
But if you get a big surprise and you owe money, then that's not fun either.
Yeah.
But something was wrong, and you want to be able to pay taxes on our terms. So I like to pay taxes when I have the money.
Yeah.
So typically, while I have people working still, I'll get them to pay some tax now.
Oh, you pay tax now,
debt.
and you're not paying that tax debt later.
Yeah. So I look at it as kind of like that second mortgage in retirement taxes. So we got to battle it along the way.
I agree that taxes is a major expense in retirement years, and there are ways to pay that tax early so you don't pay it as it escalates with growth.
Right, and usually, if it's an unplanned thing, the amounts get higher and higher, and then you have to take the taxes on top of the amounts that you need, for emergency situations, and it can just really mathematically do horrible things.
Can you explain that more?
So, let's say there's like this blind spot in your plan, and you have to pull out $100,000.
Yeah.
But your income is already $150.
Yeah.
And then you need $175.
Yeah.
It's like, I need what?
I have clients retire a lot of times in the middle of the year. I mean, you make their salary, and if they work for certain government agencies, there might be a sick leave bonus. Then they hit their pension, and then they'll come in and say, "Oh, I got a part-time job in November, so the last 2 months I worked that job, but they didn't take any taxes out." And I said, "Yeah, because they think that's the only job and the only income you have for the year. So you might have made $5,000, but you're going to owe like $3,000 of it in taxes because of the way things are." Or when people retire, they get given a 1099 instead of a W-2. And they don't really understand the difference between that. All important facts to know. So the key thing is this. When you do financial planning, it matters. When you work with Acres Financial Group and the financial planning team, what happens is this. We get to know your situation and help you pay the least amount of tax to make your money last a lifetime. We want to balance this tax over time. So Acres Financial Group, we invite you to meet with one of our team of advisors. Go ahead to our website, acresfinancialgroup.com. Scroll down the schedule a meeting section and let us know you'd like to schedule your free meeting. That's acresfinancialgroup.com. Or give us a call at 833-WIN-RETIRE. That's 833-WIN-RETIRE. We'll give you a call on Monday to schedule your free in-person or Zoom meeting with one of our team of advisors. Start planning for your retirement now. Go to acresfinancialgroup.com or just give us a call. Thank you for listening for the third quarter of our show. And we want one more comment, and that is this. Tax credit or tax deduction? Which is better? We'll explain in the fourth quarter in just 2 minutes.
You're listening to a pre-recorded show. Welcome back to Winning in Retirement. Call 833-WIN-RETIRE now to schedule a visit with Brian and his team and begin winning in retirement. Once again, here's Brian Akers.
Welcome back to Winning in Retirement. I'm Brian Akers. Here with me today is Alex Monk, and we're in the fourth quarter. Fourth quarter is always a fun time of any game, especially during basketball season. The fourth quarter is definitely a winning time.
Oh, yeah. And, the nice part about March, it means tax time.
It is tax time. That's why we put together this show. It's called Tax Time Tips to help you keep more of your money.
I think people want more of their money.
They do, and they need to spend a little bit extra time getting ready to do their taxes or getting ready to turn that paperwork in. Now, as we started out the show, we explained that Acres Financial Group has a company called Daniel Allen Tax. Daniel Allen is A-L-A-N Tax. On the website, DanielAllenTax.com. That's our website where you can go there and see our tax preparers, and you can actually have Acres Financial Group's Daniel Allen Tax Company organize your taxes and do them for you. Affiliated, yeah.
Yeah.
That's the proper way to say it.
I like that. That's cool.
But the reason we bring that up is that yes, we have a preference for having tax being prepared for our clients because we want to make sure everything's done right. When in conjunction with an advisor, what we do is make sure the planning is reflected in the taxes, which doesn't always happen when someone has an outside tax preparer.
Oh, yeah. And sometimes, and I've gotten in arguments with people's CPAs, like, why are you doing this? I'm like, I'm trying to do a Roth conversion so the guy doesn't have to take a required minimum every,
right.
This is why.
Right. So imagine that, let's say accountants are doing the taxes. Sometimes they'll do them as these are the numbers, and numbers are the numbers. We think there has to be advice on top of that to help you pay the least amount for a lifetime. That means sometimes you pay more than you might need to in 1 year to pay less for a lifetime. And that's all about maximizing your tax bracket, which we have a lot of shows on this topic because we want people to understand winning in retirement is keeping more of your money.
Yeah. I mean, if I can save you 10% in taxes, like that's a huge number. And then that makes your return hurdle so much lower.
Absolutely. So what we're going to try to do here in the fourth quarter is just explain a little bit more about tax credits versus tax deductions to understand what that means and how that affects you. Also, just to remind you, all the topics we've covered so far, you can go to our website at acresfinancialgroup.com under the radio tab. You can hear this show again. It'll be on that website just a few days after the show goes live. Also available on podcasts out there. The idea is this: tax time tips. You need to see how it applies to you and how we can help you with making sure you keep more of your money. All right, so tax credit, tax deductions. Which one's better?
The credit.
Why is the credit better?
So the credit is actual like dollar for dollar.
Okay, so where I'm trying to picture how that works.
So like at the end of your return.
I'm trying to play dumb here. It's hard being a financial advisor asking you a question.
All right, so at the end of your return, right?
Yeah.
They say, okay, Brian, this is how much tax you owe.
And you're like, oh my, that's awful.
And then underneath that, there's a section for a place where you've paid in, right? So that's dollar for dollar, right? And then there's that magic credit line.
Yeah, there's the multiple lines there, and not everyone knows what they all mean.
Yeah, I mean, no one knows what they all mean.
But that's truly the magic in a tax return is understanding those tax credits on that line there.
Right. So that credit, it takes away, like if you get a $2 credit, that's $2 in taxes you don't pay. Right. If you get a deduction, that's a deduction in taxable income. So if you get a $1 deduction, you're really only saving 22 cents or whatever your effective tax rate is.
For example, if you itemize and you have a charity and you deduct, you don't get a dollar for dollar off the taxes you owe. It's off the top income.
Right, off the taxable income. So it's a percentage. Like it's usually 15 is about the average normalized rate of people that you see a lot of. So it's somewhere between 22 and 12.
So what tax credits do you see on tax returns that people have brought to you?
Child tax credit.
Okay, so you get to deduct a child up to what age?
17.
Yeah,
17. A couple other caveats.
17, and then they're gone off your tax return after that.
Which is weird because it seems like a lot of kids still live at home at like 30.
So I don't mean to be mean, but you're right. It's true. But they're not deductible anymore. It's actually better probably for college planning to actually have them file their own return later on.
Yeah. Well,
you just got to watch what's that
art degree is really doing wonders in the basement,
It can be if you have a business degree tied to it.
Well, I mean,
like some people I know.
I do know successful photographer, yes.
Yes, I do.
Chloe Marie.
All right, so what happens with tax time tips is we're trying to explain some simple things. Tax credits, the second page of your tax return, there's some lines there. Some of them are energy credits. There's these college credits depending on your income. There is investment credits for different ways of investing money. There's a credit for the child care credit. There's some other things on those lines that you might need to take a look at, see if they apply to you in your situation.
And they're all tied to income, and there's different ones that are available based on your income level. So in your tax planning, it's important to know what you give up when you make a big taxable decision. Right. So you need to know everything, because a lot of times it's not just like, oh, I jumped the brackets 10%. No, there could be other, that IRMA thing you're talking about. There could be tax credits you lose, deductions you lose, et cetera. So you got to know.
All right. So let's just, winning in retirement, we're talking for people that are working and actively working, a lot of that. And then just pure retirement taxes. People that are retired, they're getting Social Security. Is the Social Security show up as taxable?
Yes and no. So
what would you make your mind up? Is the Social Security taxable?
Maybe.
Real committed.
All right. So 85% of your Social Security is potentially subject to tax.
So on the front page of your return, you'll see your total Social Security in the middle of the return. And on the right column, you'll see what's taxable.
Right. It's that magic number that randomly pops up.
Right. And the lower you get your other income, you can make your Social Security taxation disappear to zero.
Yep.
But it has to be very low.
It's really hard to do.
Yeah.
So it's like a provisional income.
Correct.
And it's completely crazy.
And there is special planning advice tied to making Social Security not as taxable if you're close to the numbers.
Right. And that's a hard thing to do, meaning that you aren't able to show a lot of other income ever. So if you have a pension or something like that, that's difficult to get around.
Yeah. If you have a pension, you might never qualify for that. So there's no reason to consider it. And that's, or if you have enough investments, enough other accounts. But if you're looking at your tax return and you don't bring in a lot, you don't have a lot saved, is there a way to make you never pay tax again? Maybe if we do a Roth conversion, pay tax once, all of a sudden you never have an IRA withdrawal, and then you might be just below what you need for income. You might never pay tax again. We've done that a couple of times for retired people.
Yeah, and I've seen a lot of clients come in there and actually helping their parents, right? They're that sandwich generation now.
Yep.
And it's like, mom doesn't need the money. We're still doing this RMD. And it's like, okay, well, maybe we can get rid of that RMD in 2 years.
Correct.
And then it benefits the kids. And that's, depending on different goals, they usually want it to pass.
Yeah, so tax planning applies to different times of life. So imagine we have the retiree, we have pensions, they are taxed in federal. In Maryland in 2022 is the beginning of the new retirement tax credit that you get on your return. That's if you're over 65 years old. Make sure that that's entered in. There's also the exclusion for Social Security and other pensions once you're 65. And there's exclusions for first responders. Make sure all of those are picked up on the return, and you tell them, yes, I'm a first responder. Yes, I do this. They need to know those kind of things. The other issue is that in tax planning, to get proper deductions, you need to plan ahead. So imagine that I have this one client, and she's in assisted living, and so we get a letter every year saying this portion is medical cost. And so we take out more than that out of the IRA, because whatever we take out of the IRA, we have a tax deduction for medical because we're way over the limit, under the 7.5% limit. And so we can deduct dollar for dollar off of the IRA income. So we're basically running the IRA through at a zero taxation in that situation because of the way her situation is right now.
And that's really ultimately the best thing to do, right? Because it's always
best for her to pay her bills, and best for her family. On whatever's left over will go to the family tax, more of it tax-free, because we've paid the tax at zero because of taking the medical deduction against it.
And if you don't do that, that medical deduction goes away. It's not something that transfers at death or anything like that. So you got to, those things matter in the year.
Imagine that you do a return and you end up with a bad year, a lot of deductions, and you end up with like a negative income on your tax return. That's a missed opportunity because you could have taken more taxes. Some examples might be is there's a company that got started, had a lot of startup costs. So we did a Roth conversion during the startup year. So they lost like $70,000. We did a conversion of 70, got them up to a zero tax rate, but they converted all their IRA, all their little 401k plan to tax-free for life with zero tax because of the way their business was showing up.
Yeah, and that's such a huge win. And a lot of people miss those tax planning opportunities, but I really think it's the name of the game.
A lot of those are done during the year before you file your taxes. It's not done after the fact. So here we're talking about tax time tips on how to keep more money. We're trying to close out the show here with some fast, quick advice. Now, our number one thing we started out with is just the idea of reviewing your information, gathering it, and getting and having a conversation with your accountant.
Absolutely. And ask questions. I mean, it shouldn't just be a drop off and this is your number.
Yes. And or it's the same as last year, unless it is, but most likely things change in life. Make sure you got them all, picked up them all, give them the information. Make sure you understand things that change in your life and tell the accountant about all of that. We think having a tax preparer helps you maximize your tax savings rather than trying to do it yourself. Yes, software can guide you through it, but the surprising cost might not be worth the difference.
It's usually like, whoa, it's this much?
Or I'm going to spend the whole weekend doing my taxes, or you could drop it off for $50 for someone else to do it.
Right.
$50 extra. Beyond
$50 extra in that whole 8 hours. Like, sign me up.
Time's money. The other thing, the more businesses you have, the more information and more stuff you need to work on with your taxes. So, tax time tips. To keep more of your retirement refund money, the key thing is understand the information needed to provide. Make sure you do that. Thanks very much for a good show there, Alex.
It's been fun, Brian.
Absolutely. At Acres Financial Group, everything we do is about you, the client. Your retirement is as unique as your fingerprint. When you sit down with one of us, we'll start by taking a look at your financial fingerprint. Where is your money? How much do you have? How much are you earning? Then we'll discuss what you want your retirement to look like and to feel like. That's your retirement fingerprint. Perhaps you've been sold something, regardless of whether you needed it or not. Not at Acres Financial Group. With us, your retirement money follows your financial fingerprint. It's a retirement plan based on your unique fingerprint. And that determines where your money goes. It's not about us, it's about you. So give us a call at 833-WIN-RETIRE. That's 833-WIN-RETIRE. And we'll give you a call on Monday to schedule your free in-person or Zoom meeting with one of our team of advisors. Start planning for your retirement now by going to our website at acresfinancialgroup.com or give us a call at 833-946-7384. Thank you for listening. I'm Brian Akers from Acres Financial Group, and we want you to be winning in retirement.
You've been listening to Winning in Retirement with your host, Brian Akers of Acres Financial Group. Acres Financial Group offers securities through Archedios Capital, an SIPC and FINRA member firm. Advisory services are provided through Archedios Wealth. Acres Financial Group and Archedios do not share any common ownership. Neither Archedios nor Acres Financial Group provides tax or legal advice. Advice given on winning in retirement is general in nature, and one should seek further advice from their financial advisor, broker, attorney, and or tax accountant before investing. Be sure to read each prospectus carefully to understand all the risks associated with each investment. Examples and scenarios shared are meant to be for illustrative purposes only. Past performance is not indicative of future results.